In the first half of this year, we saw significant falls in both equities and bonds, begging the question of whether now is the right time to buy. Unfortunately, we think it's still a little too early. First, inflation has forced many central banks to stop quantitative easing and instead quickly pivot to hiking interest rates. There's a risk that this creates a regime shift. For the past decade, investors chased what little yield they could get in markets as central banks suppressed volatility. Traditional concepts of valuation were pushed to one side. Now that interest rates are rising, we need to find a new equilibrium for valuations in a world where inflation risks are two-sided. Secondly, looking at our cyclical models, we're moving to what we call the slowdown phase of the cycle, which is characterized by inflationary pressures remaining high but slowing growth. Typically, it's this slowdown phase of the cycle that's most challenging for equities, as earnings expectations have to reset lower as growth slows. Both of these conclusions are negative for equities, and thus we remain underweight for now. However, we are not maximum underweight. Valuations have improved, and if inflation does show signs of peaking, then we could see a strong bear market rally. Moreover, we're finding some attractive opportunities, such as in value as a style and in China. On the bond side, the risk of recession provides support for bonds, and thus we've reduced underweights, even moving neutral in some areas. Here, we continue to debate the economic outlook to determine what our next step should be. Hopefully, by the time I film the next video, we can stop asking the question, are we nearly there yet? And instead start asking, where next?